In today's episode of nftraderr, we highlight a crucial skill that every trader must master: the ability to identify high-quality and valid changes of character in the market. Recognizing these shifts is foundational for anyone aspiring to become a profitable trader, as overlooking them can result in falling into market traps that can significantly impact trading outcomes. We will outline key criteria and rules that can help transform a change of character into a high-probability trade, enabling traders to make more informed decisions. If you're eager to enhance your trading skills and gain deeper insights into market dynamics, be sure to give this video a thumbs up and subscribe to our channel for more valuable content. CHOCH, or change of character, refers to a crucial moment in market dynamics marked by a noticeable weakening of prevailing momentum. This phenomenon typically occurs when the established trend begins to falter, signaling a potential transition in the overall market structure and order flow. Traders often view a change of character as an early indicator that control may be poised to shift from buyers to sellers, or alternatively, from sellers to buyers. Such shifts can suggest an impending reversal or alteration in price direction, making it a significant signal for those analyzing market behavior. To identify a valid change of character in the market during a bullish scenario, one should look for a breakout above the most recent major high in conjunction with a demand zone. This shift indicates a potential reversal in the prevailing downtrend, particularly after the market has consistently formed a series of bearish structure breaks. In essence, the market structure transitions when the price sustains a close above these key levels, signaling a possible shift in momentum and a new upward trajectory. The same principles apply to bearish conditions, where a break below significant lows would highlight a similar change. Importantly, with each zone that breaks, an opposite zone is established. Thus, the recent breaches of multiple demand zones have created a supply zone at the extreme. Consequently, we anticipate a price movement toward this extreme supply zone. Should the price react positively at this level, it presents an opportunity to enter the market with buy positions. Following the mitigation of the extreme demand zone, which was identified through the change of character in the price wave, we observed a significant reversal in market direction. The emergence of this pattern is critical, as it signifies a pivotal alteration in market trends, embodying the transition from bearish to bullish or vice versa. In analyzing the current market structure, we observe a significant change of character characterized by the price breaking and closing below a key major low. Additionally, we see that price breaks through this order block, and it's noteworthy that the price has not left any unmitigated order block behind itself. As you can see, all of the supplies are mitigated before, so this means as the price breaks through the latest order block, it signifies the formation of an order block. As mentioned earlier, whenever a zone breaks, an opposite side zone is automatically formed, therefore a newly generated unmitigated order block emerges at the extreme. Considering this, entering a long position based on this demand zone is a viable option. There's a high probability that the price will return to this order block, react to it, and then change its direction to the upside. Now let's move into essential criteria and rules that we need to consider in order to identify valid and high-quality change of character patterns in the market and understand how we can use them to our advantage. The first criteria in valid CHOCH is failure valid high or low in trend. For example, in the figure below, we see higher high and higher low consecutively. At the top of the chart, before a new higher high is formed, the chart has broken down and broken the bottom we marked with the green circle. This failure is not considered CHOCH, because it has not passed a valid low and is called change of character fake. As long as the price does not break the lower valid that we have specified in the figure, no change of character has occurred. Consequently, while CHOCH remains absent, the market structure continues to be bullish. The scenario where the chart moves upward, breaking the previous high and creating a new higher high, HH, the last low would be adjusted accordingly. Should this last low be broken, it would signify that a CHOCH has taken place, indicating a potential shift in market dynamics. This framework is essential for traders to understand market behaviors and to make informed decisions based on structural changes in price action. Higher time frame. To identify a valid change of character in trading, the criterion that must be met is higher time frame mitigation. This means that for a change of character to be considered valid, the price must reverse from a higher time frame supply or demand zone before breaking the recent major structure. If the price creates a change of character without interacting with these zones, Even if there is a valid candlestick pattern, it cannot be deemed a legitimate change of character. This requirement ensures that the price movement is anchored in significant market areas, providing a more reliable basis for analysis. This crucial point prevents us from falling into traps caused by false reversal changes in market character and trading in the wrong direction. For example, in this market structure there is a fake CHOCH. Many new traders often believe that the bearish phase has ended and it's an ideal time to go long with the newly formed demand zone. They typically place their stop loss just below this new demand zone. However, contrary to their expectations, price made a brief upward move, mitigated the upper supply and then continued. Many traders fail to understand why this happens, inadvertently repeating their mistakes. A key aspect often overlooked is that the price did not reverse from an unmitigated demand zone. They should have waited for the price to reach a significant unmitigated demand area before entering long positions, as their identified change of character was invalid and the upward movement was merely an action to mitigate supply. It used the last supply zone as an inducement zone to sweep more liquidity and gain more momentum to fuel its downward movement. This scenario highlights that without a proper understanding of market structure, for valid trading, it's crucial to wait for the price to establish static liquidity zones near our identified higher time frame areas of interest. Liquidity refers to specific market zones where a significant amount of capital is concentrated, such as stop-loss orders and buy or sell orders. The most practical types of static liquidity commonly observed include equal lows, equal highs, and dynamic trend lines. Each of them falls into distinct categories like double bottom or double top and triple bottom or triple top patterns, bearish or bullish dynamic trend lines. Imagine recognizing a liquidity sweep pattern before the price reaches our identified area of interest is crucial. This pattern confirms the strength of our supply-demand area. We use liquidity sweeps as a confirmation factor. The idea is simple: market requires liquidity for momentum. If the price doesn't sweep liquidity before a key level, it often uses that zone as liquidity to fuel its momentum. As a result, if price taps into higher time frame supply or demand zone without sweeping liquidity and subsequently price shows a rejection and also creates a change of character pattern on the lower time frame. However, there is a high chance that price will continue moving in the opposite side of the newly generated change of character and also fails and triggers the stop loss of the traders who have entered into the market with the expectation. In this trading example, after the price reached a significant bearish order block on a higher time frame, an entry signal appeared, but no position was initiated. Subsequently, a new bearish order block was formed, accompanied by a break of structure, BOS, that eliminated a strong demand zone. A limit order was placed on this order block, with a stop set 1 pip above it and the target positioned at the opposing order block. As a result, this trade yielded a profit of 12 reward. Traders, thank you for watching this video. I hope you found it informative and useful.